Warren Buffett, often regarded as the greatest investor of all time, has recently made headlines with a significant move, selling off a massive chunk of his stock portfolio. Just a few days ago, Berkshire Hathaway released its quarterly earnings report, and a deep dive into the balance sheet reveals some major changes that are catching everyone's attention. If we zoom in on Berkshire's stock and bond holdings as of March 31st, 2024, we can see that the company held $153.4 billion in short-term U.S. government bonds and had a stock portfolio valued at $335.8 billion. At that time, Buffett's portfolio was about 31% in government bonds and 69% in stocks. Fast forward just 3 months later, and as of June 30th, 2024, those figures changed dramatically. Berkshire now holds $234.66 billion in government bonds, an increase of over $80 billion in just 1 quarter. So where did this influx of cash come from? It came almost entirely from their investments in stocks. As of June 30th, Berkshire's stock portfolio had shrunk from $335.8 billion to $284.5 billion, which means Buffett sold at least $51 billion worth of shares in just 3 months. But if we account for the reported stock gains of $23.9 billion during this period, it becomes evident that Berkshire actually sold around $75.5 billion worth of securities. This is a staggering figure for just 1 quarter. The big question now is, what exactly did Buffett sell, and why did he make this move? As some of you might have already guessed, the biggest change to the portfolio came from a single stock, Apple. A closer look at the report shows that last quarter, Berkshire held $135.4 billion worth of Apple shares, but that number is now down to $84.2 billion, a reduction of $51.2 billion. This marks a dramatic shift, as Apple, which once made up 50% of Berkshire's portfolio, now accounts for just 30%. Although it remains Berkshire's largest position, at roughly double the size of the second largest holding, Bank of America, the extent of this sale is unprecedented. To put it in perspective, Buffett began selling Apple shares in Q1 of 2024, reducing his position by about 13%. While this move was noted at the time, few anticipated that he would continue selling at such an aggressive pace in Q2. With over $50 billion worth of Apple shares sold in 1 quarter, this is likely one of the largest divestments of a single stock that Buffett has ever made. But this brings us to the next big question. Why is Buffett selling Apple? Buffett's decision to sell Apple stock is surprising to many, especially considering his long-standing admiration for the company. Over the years, he has praised Apple as one of the best businesses in the world, and his investment in the company has been a cornerstone of Berkshire's portfolio. So why the sudden change? To understand Buffett's reasoning, it helps to go back to the Berkshire Hathaway annual meeting in Omaha earlier this year. During the meeting, Buffett took time to explain his rationale for selling shares, and it wasn't what most people expected.
And I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now. One interesting thing is that Charlie and I looked at common stocks or marketable equities, or the things that people love to look at, as being businesses. And so when we own a Dairy Queen, or we own whatever it may be, we look at that as a business. And when we own Coca-Cola, or American Express or Apple, we look at that as a business.
He made it clear that his decision wasn't about losing faith in Apple as a company. Instead, it had more to do with his concerns about the broader fiscal landscape in the United States. One key factor driving Buffett's decision is taxes. As he explained at the meeting, Berkshire is currently paying a 21% federal tax rate on its capital gains. This rate, he noted, is much lower than it has been historically. In fact, it was as high as 52% in the past. Buffett expressed concerns that with the current fiscal policies in place, the U.S. government would likely be forced to raise taxes to address its growing deficit. The U.S. national debt is swelling, and the cost of servicing that debt is rising rapidly due to higher interest rates. Buffett believes that sooner or later, the government will have no choice but to raise taxes on both individuals and corporations to tackle the deficit. For Buffett, selling Apple now allows him to lock in his gains at the current 21% tax rate, rather than risking a much higher tax burden in the future. It's a strategic move, particularly for a long-term investor like Buffett, who must weigh the impact of taxes on his returns. By selling Apple stock at this lower tax rate, he's effectively hedging against the risk of future tax hikes. But there's more to the story. Buffett's decision to sell Apple also reflects his broader outlook on the U.S. economy and the stock market. During the meeting, Buffett made it clear that he sees the U.S. deficit as a significant issue that will need to be addressed in the coming years. He believes that higher taxes are inevitable and that the U.S. government will likely raise the corporate tax rate as part of its efforts to reduce the deficit. Currently, the U.S. corporate tax rate is 21%, which is the lowest it has been since the 1930s. However, Buffett pointed out that it's been much higher in the past, and if the government decides to tackle the deficit seriously, raising the corporate tax rate could be one of the first steps. For an investor like Buffett, who is always thinking long-term, the prospect of higher taxes in the future makes locking in profits at the current rate a smart move. At the same time, Buffett's decision to sell Apple provides insight into his views on the company's future performance. While he still believes that Apple is a great business, he seems to be signaling that the stock's valuation may have become too high relative to its earnings. When Buffett first invested in Apple in 2016, the company's price-to-earnings (PE) ratio was around 12, meaning investors were willing to pay 12 times the company's earnings for its stock. Since then, Apple's earnings have grown, but its stock price has risen even faster, leading to what's known as multiple expansion. Today, Apple's PE ratio is closer to 34, meaning that investors are now willing to pay almost 3 times as much for the same level of earnings. This kind of multiple expansion can be a warning sign for value investors like Buffett. While Apple has continued to perform well, its stock price has risen so much that it may no longer represent a good value, especially in a market environment where higher taxes and economic challenges could weigh on future returns. Buffett has also indicated that he's more comfortable holding cash right now. In fact, Berkshire's cash pile is now at a record $276.5 billion. This move suggests that Buffett is positioning himself defensively, preferring the safety of U.S. Treasury bonds over the potential volatility of the stock market. As Bloomberg has reported, Buffett has been building up Berkshire's cash reserves, likely in anticipation of future opportunities. By holding cash, Buffett is giving himself the flexibility to make significant investments if and when the market corrects. In addition to his concerns about taxes and valuations, Buffett's decision to sell Apple also reflects his broader concerns about the state of the U.S. economy. Rising interest rates, inflation, and geopolitical tensions are all factors that could contribute to market volatility in the coming years. By selling Apple and increasing Berkshire's cash position, Buffett is positioning himself to weather any potential storms and take advantage of future buying opportunities. Buffett's move to hold more cash is also influenced by the current interest rate environment. With U.S. Treasury yields hovering around 5.35%, holding cash is no longer as punitive as it was in recent years when interest rates were near zero. In this environment, cash offers a reasonable return without the risks associated with stocks, making it a more attractive option for a conservative investor like Buffett. In conclusion, Warren Buffett's decision to sell a substantial portion of his Apple stock is a strategic move that reflects his concerns about the future fiscal landscape in the U.S., the stock's high valuation, and the broader economic environment. While he still believes in Apple as a business, he's hedging his bets by locking in profits now and building up Berkshire's cash reserves. As always, Buffett's actions serve as a reminder that even the most successful investors must adapt to changing market conditions and carefully weigh the risks and rewards of each investment decision. For investors looking to understand Buffett's mindset, this move provides valuable insight into how he navigates uncertainty and positions himself for the future. Whether it's the prospect of higher taxes, concerns about stock valuations, or simply a desire to hold more cash? Buffett's decision to sell Apple reflects a thoughtful and calculated approach to managing risk in an unpredictable world. A future trend emerging from Warren Buffett's recent moves centers around the growing focus on capital preservation, especially in response to fiscal uncertainties. His decision to sell a significant portion of Apple stock and build up Berkshire's cash reserves reflects a cautious approach that may become more widespread among investors. As concerns about rising interest rates, inflation, and the potential for higher corporate taxes continue, investors may increasingly prioritize safer, more conservative investment strategies. This could lead to a notable shift away from high-growth, high-valuation stocks towards stable assets like government bonds or cash equivalents. Additionally, Buffett's actions signal a broader market trend where businesses and investors anticipate a higher tax environment in the coming years. With corporate tax rates currently at historic lows, the expectation of eventual tax increases could drive more investors to lock in profits now rather than face heavier tax burdens in the future. In a higher tax landscape, corporate earnings may be impacted, leading investors to reassess the valuations of major companies, especially those that have experienced significant multiple expansions. This trend could also result in increased market volatility as more investors, particularly long-term value investors, reassess their portfolios and hedge against potential economic downturns. The broader economic environment, marked by geopolitical tensions and fiscal challenges, may further reinforce the importance of maintaining liquidity and flexibility to take advantage of future market opportunities. This focus on adaptability, along with a more cautious approach to growth stocks, could shape investment strategies in the coming years. If you enjoyed this, don't forget to like, comment, and subscribe. Your support means the world, and it helps us keep bringing you more great content. Plus, I'd love to hear your thoughts. Drop a comment below.